when you hear people on the news talk about inflation is cooling, it means the rate of growth is slowing down, not that inflation is going backwards.
First up, it's Adrian from Little Rock. I've heard recently that inflation is cooling, but things feel really expensive. Can you explain the inflation numbers and how I can adjust to them? Great question here, Adrian. You know, inflation was the buzzword for all of 2021 into 2022, and it was pretty high. We've got a graphic to show you that here in just a minute. But, John, it has been cooling. But I think where people get a little off track on their thinking here is when you talk about an inflation rate cooling, that doesn't mean prices are going down.
Yeah, the inflation rate didn't go in reverse, didn't go negative. And that's what you would have to have if you were to see prices decrease. Prices don't decrease as a general rule. And frankly, if you study deflationary environments, you will figure out you probably don't want any of that either. So let's talk a little bit about what's happened here. So, Scott, very simply, if something costs $1 and it goes to $1.10, that's a 10% increase in inflation. Now, we haven't had a 10%, but we did have a 9% annualized increase in inflation back about a year or so ago. Now, what happens then? Well, if inflation goes down from 10% to 3%, that $1.10 product now is worth about or is going to cost about $1.13 or so. So prices didn't go down, but inflation actually cooled, meaning that it went from 10% to 3%. It still went up. It just didn't go up as much. And so that's when you hear people on the news talk about inflation is cooling, it means the rate of growth is slowing down, not that inflation is going backwards. Now, in most cases, the only time you see inflation going in reverse or something decreasing in price is when there is a decrease in demand. But Scott, you know, there's still a lot of money out in the money supply, and the higher interest rates haven't really had a major effect on that. And we are seeing that kind of cool the inflation rate, but it's not causing demand to go away. When demand goes away, that's when you have a recession.
Yeah, and, we've talked about this before, John, as the reason that inflation spiked in the first place was in the COVID pandemic. We had a shutdown, right? And we stopped making things. And then demand was really off the charts because people weren't able to buy things for a little while. And then when they were out there buying again, the production was not keeping up. So demand exceeded supply, and that's what caused inflation to spike. Otherwise, we could have been on this really more smooth path of inflation. But back to our earlier point, I think about my dad, and I've told this story before too, but my dad's 80 years old, and he loves to tell me about going to the movies when he was a teenager back in the 50s, okay?
Yep.
Sorry, Dad, I already said you were 80, so everybody knows how old you are. But he could go to the movies, buy a Coke and a popcorn for 35 cents. I mean, you think about that, right? But those days are never coming back. To our point, the inflation or prices are never going to come down. We've got a graphic showing the U.S. annual inflation rates just over the last decade. So take a look at this if you're watching online. U.S. annual inflation rates from 2014 through this year. And you see, I would almost say artificially low about 10 years ago, under 1% inflation. Now, that would be great, but every year prices have still gone up. Even though it was not very much in 2014, they were still going up. And then you see that spike as you get to 2021 in the post-COVID year of 7%, and it has been cooling to Adrian's point, down to 3% on average year to date through 2024. But when you think about the second part to his question, John, and he says, how can I adjust to them? You have to accept that fact first, that prices are always going to continue to go up during your lifetime.
Right.
So how do you deal with it? And I want to kind of take it from a couple of different places, but the first part here is in the now, and then the second part is in the future. That's how we'll take this question on.
Yeah, so in the now, let's talk a little bit about wage inflation, because I think that any talk about inflation is really only half the story unless you look and see what has happened with wages. So we've got another graphic that I think is really interesting when you look at the dynamic here. So you see early on in March of 2020, wages were staying way ahead of inflation. Inflation was maybe down around 0 or 1%, somewhere in that neighborhood. Wage inflation was around somewhere between 2.5% and 3%. Well, when COVID came into being, we saw inflation shoot up, and it outstripped the gains that were being happening that people were enjoying from their job pay increasing. And so you had this break where inflation got ahead of us. Now inflation has come down, and probably in the last, say, year or so, maybe a little bit longer than that, the rate of growth of inflation has been less than the rate of growth of income in the United States. And so when you compare that, you can see that we're still suffering that lag effect of those higher prices, and those prices are actually staying up and continuing to increase, although wages are not increasing as fast.
Yeah, so the point here for Adrian is, what can you do in the now? It's to work on that career, right? You cannot work at a job for 30 years and never get a raise. You're never going to keep up with inflation. So the point here is to either look for ways to advance in your current positions, or look for ways to get more educated and find a better career path that will lift that income and keep it ahead of inflation.
And let's not forget the gig economy is still alive and well out there, and you can make extra income. You just can't go spend it on frivolous things like you might have in the past and saying, hey, I want to fund some cool trips or something, so I'm going to go and get some extra income from some gig that I get. You can't do that, but you can be in the way of building that into your cash flow. Now, when you do that, then you have to also be thinking, okay, how can I lift myself, as you were saying, Scott, in my permanent job, so I may not any longer need that gig economy to bridge me. But that is a quick way that you can overcome this spike in inflation.
Yeah, and as a sidebar to that, you always hear us talk about margin here. That's the difference between your income and your expenses. Keeping that margin helps you deal with rising prices as well. So don't increase debt while you're trying to increase your income. And then to the second part of that, the later. So that's what you can do now, begin to work on now. But for the later, and you can begin to do this now, but it is for your preparations in retirement, and that's invest in asset classes that have historically outpaced inflation. That's where we can get, we've seen in August some serious market volatility. The market has dropped. It causes people to get a little fearful of staying invested. They might get too conservative, and the next thing you know, they've gone a decade of higher inflation rates without investing in something that's going to have long-term growth.
Yeah, and that long-term growth is what you have to stay ahead of inflation. Frankly, it's equities and it is real estate. Those are the two asset classes that have kept people ahead of inflation throughout history as a general rule. Nothing stays positive all the time. We saw real estate actually back up a little bit in value during the post-COVID period of time. So it's one of those things that you've got to be very careful in terms of how you think about that, because, Scott, you can get scared, as you mentioned, out of equities, and that can really be a situation that works against you. And now you're battling two things. One is the loss that you might have by being scared out of equities, and then secondly, the loss that you would have by not being able to keep up with inflation as a result of you being out of those equities.
Adrian, I hope that helped, and we thank you for sending in your question. We want to give you another free resource if you're looking for more information, and anyone listening or watching can do this too. Download our free guide called 7 Steps to Financial Independence. It is easy to do. All you have to do is text the word STEPS to 501-381-5228. Again, the number is 501-381-5228. Just text the word STEPS to download that free guide, 7 Steps to Financial Independence. You can also get it by visiting our website, getreadyforthefuture.com/steps.